All right, this is session 2 of 6. This one is called Indicators. What's it all about? Last session, I covered the ABCs of technical analysis, so I'm going to do a quick review of what we covered. And that is that everything there is to know about a company, all knowledge that can affect a stock, is already in the chart. And the reason is because the chart, which is the price and volume action of a stock, is the result of every trader in the universe placing actual real bets on that stock, buying and selling. And so those chart patterns are the results, is the composite knowledge of everyone involved with the market. It is their opinion that is influencing the gyrations in any chart. Hence, the price and volume action in a chart represents the composite knowledge of everyone's knowledge and speculation. All right, that's very key, because the moment you hear somebody talking about company fundamentals, you have to understand that if they know it, so do 100,000 other people, and that's already in the chart. It's as simple as that. So, the three components, as discussed in the last session, all technical analysis, no matter how complex it looks, no matter how spiderweb the example charts look, there's really only three components to all of technical analysis, and they are support and resistance, trend, and momentum. Now, as stated before, there are hundreds and hundreds of combinations of these things and hundreds of ways to look at them. And that is where you get the apparent complexity. But it really comes down to these three components. And to briefly go over them, support and resistance is simply the channel in which a stock tends to trade at any given time. Those two lines there show that the stock is bouncing off of support and resistance. So every time it reaches this line up here, it tends to fall. You see that? It falls. It bounces up here many, many times, and it falls, and it falls. But every time it gets down here, it bounces. Whoops. This mouse is out of control. Here we go. Get a better color so you can see it. Yeah, see how it bounces off of support? Right here it started crashing through support, but it came flying back and then it bounced again, see? And then it bounced here like 4 times in a row. You get the idea. That's support and resistance. And by the way, the reason this formulates is because it's literally a self-fulfilling prophecy. Because, see, other traders see this channel. They're sitting there and they see this channel, okay? So when the stock gets down here, they go, oh, it's at support, and they all start buying it, and so it goes up. So it's kind of a self-fulfilling prophecy. But nonetheless, it still works. Trend, the second component, it relates to time. Now, what I mean by that is, if you look at that section of the chart, we have a downtrend, because as you can see, that part of the chart is slanting downwards. However, if you look at a larger part of the chart, that section, it's slanting upwards. So when you speak of trend, you have to include the time frame that you're looking at. You could have a 15-minute uptrend, but a downtrend for the whole rest of the day. Today was a good example, you know. The whole market trended downwards, but there were little pockets and moments where it was trending upwards. So trend is in relation to time. Momentum is how it relates to trend. Momentum, I define momentum as trend plus volume. So you got a very steep uptrend there, but you got heavy volume there. If you look at it, this volume is more than double, even quadruple of the normal volume that the stock trades. That's called momentum. It's a bandwagon, everybody glomming on effect. Some people call it greed. I call it just, opportunistic trading. Okay, now, that being covered, to summarize the previous session, I'm going to assume that people here don't know a whole lot about chart indicators. There obviously are people that I know are in the audience now that know all about it, but I'm coming from the assumption that you're new and you're learning. So I'm going to show you, not all because we don't have time for that. I'm only going to show you some of the more popular indicators to use on a chart, so you can see that one of these three components are a combination. And these, I admit, these popular indicators are the ones that I use. I don't use all the indicators. I only use certain ones, and I'm going to show you those. Simple moving average is probably one of the most basic, oldest trick in the book type of indicators. A simple moving average is what it sounds like. Okay, imagine you've got these bars. These bars are time intervals on a chart. And at any given bar, the stock is at a certain price, okay? If this was what we'd call a 20-period simple moving average, it would average out the previous 20 positions of those bars, and it would, it would average them out. There'd be a number. It would do that again for the next 20, and then the next 20 like that. So in other words, you'd wind up with a wave that looks something like this, because each of the points of the moving average is a summarization or an averaging of the previous 20 bars. That's if it's a 20-period moving average. If it were a 50-period, it would measure the previous 50 at each point, et cetera, et cetera. Now, why would you want to do that? Well, there's several reasons. One is so you can see the trend. When I was showing a trend a couple minutes ago, some of you newcomers are going to think, yeah, but I can't really always see the trend. Well, you're right. Sometimes it's hard. Sometimes the chart is a mess. But a simple moving average, it literally filters the noise so you can see the direction. You see, I'm overlaying a moving average across this chart, and it's blatantly obvious which direction it's moving at any given time. Obviously, since that simple moving average is slanting upwards, you can see that it's an uptrend. Right here, you can see it's downtrending. So the point of the moving average is a visual indicator of what's going on. Another purpose of the moving average is the trend reversal detection. Now remember, trend reversals are very powerful because you want to get in early on a trend, right? Well, the best way to get in early on a trend is to know when it's reversed. So if a stock is downtrending, once it reverses, that's the time to jump on it. How do you know it's reversed? Well, the easiest way to visually see is if it breaks above the opposite direction of the moving average. Here's an example. Go back here. See, right here, the stock is trading, is kind of hovering below the moving average, its own moving average. It goes a little tiny bit above here, but not very convincingly, and it falls down again. However, right here, it moves convincingly above its moving average. That is a change in trend. That almost always means that. And sure enough, the stock trends high, up and up and up and up. As a matter of fact, notice that it keeps moving higher as long as it remains above that moving average. As soon as it crashes below, right here, that's right, it falls and falls and falls until it crosses the moving average again, and then it goes up. This is not brain surgery. This stuff is pretty simple. You don't always need the spiderweb chicken scratch charts to know that a stock has reversed its trend. And if anybody you're asking, I believe this is like it's either a 50-day moving average or a 20. I think it's a 20-day moving average, this particular line. I'm not sure, but if you don't, there's no golden rule that says what you ought to set it at. You just got to play around with it until you can see the visual representation of what you're looking for. Now, another way to detect trend, a more precise way, is to moving averages. You know, we call these crossovers. These are two different moving averages with different time periods. I think one of them is like a 15, one of them is a 20, I think. I can't be positive, but it doesn't matter. The point is they're different. They're different time periods. When you do that, when one crosses the other, that's a distinct trend reversal. Hence, you can see right here is the first time these two moving averages cross in quite a while. And sure enough, that is where the trend changed. It doesn't really cross over again until right here. And that, again, is a trend change. Then it crosses here, another trend change. All right, so dual moving averages is a more precise way to visually see what the stock is doing. Notice that I keep saying visually see. One thing a lot of people don't understand, especially new people, they don't understand that these chart indicators are for your aid. It's for you to visually see things that you might miss. It's not to pick stocks, you know. Indicators are not stock picking robots. You don't use them that way. You play around with them so you can see things that you go, oh, I didn't even see that. That's what they're for. Anomaly of trend. I covered this a little bit in the last session, I think. Anomaly of trend is like thus. There's like a normal trend, okay? You know, it's wavy, but it's a normal trend. However, something like that is an anomaly. Why is that an anomaly? Because it goes against the overall trend. Now, if it kept going down, yeah, that would just be a trend reversal. But in this case, it quickly drops, but then it comes flying back. Fancy smancy technicians call that fill. You know, it fills the gap or whatever, or retrace. You know, there's a lot of fancy terms for it. All it really is happening is it's reverting to the mean. This is the mean, and it momentarily has a temporary moment of insanity, and then it comes back. That's a trend anomaly. So that's another purpose for using a moving average. You can see a sudden sharp shift, and then if you watch it carefully, it might be an opportunity to jump on it and ride it back to the mean. Notice I said might, because it might keep falling, but in that cat's a different thing. But anyway, it's a good way to visually see that. There's another type of moving average, exponential moving average, EMA. It's another fancy term. All it really means is the same exact thing as a moving average, except it's weighted. What do I mean by weighted? Well, remember how a moving average works. Each point in your chart averages a certain number of previous bars, and it comes out with a wave. Okay, that's a simple moving average. An exponential moving average does the same thing, except it multiplies a stronger value the more recent the bar is. In this example, this would be computing an exponential moving average, because if it's measuring, let me get the pen here. If it's measuring this bar, it's multiplying the resulting average by 1.0. If it's measuring this bar, it's multiplying it times 0.9, and the further back you go, it keeps multiplying it times a smaller and smaller fraction. The purpose of this is because the more recent data is weighted. So if you're looking at a moving average across a 1-year chart, if you think about it, the more recent moving average data, like say a week ago, is obviously more relevant than a year ago. So the moving average that's weighted gives you a little more precision. And look at the difference. The white line on this chart is a exponential moving average, and the green line is a simple moving average. They're exactly the same step period, the same number of bars being measured, but look how different they are. And the reason is because in the case of the exponential moving average, it's weighted. So it's a little bit stronger here. What's interesting, though, if you hold up an exponential moving average against a simple moving average, you can also see directional changes as well. Look at this exact directional change right here, for example. It goes boom, and then it flies up. See that? Here's another one. Boom, and it flies down. Whoa, I slipped there. You see that? And then here's another one here. So you could use these two different kinds of moving averages to see when it's a sharp change. You can also catch momentum that way too. Here's a fancy one for you. MACD. Everyone ever see people throw around the term MACD? For you technoids, that stands for Moving Average Convergence Divergence. Yeah, it's real rocket science, right? Well, what MACD really is a whole relationship between a bunch of different moving averages. That's all it is. Remember when I told you there's only 3 components to technical analysis. It's just the way you look at each of those is what makes it complicated. This is a good example. MACD is a very powerful indicator, but the way it's computed is, well, what it looks like on the chart is what I call a MACD line, which is usually red, and then the signal line, which is usually green. What does that mean? Well, the MACD line is 2 different exponential moving averages combined, and the signal line is the exponential moving average of the MACD line. Very weird, huh? So it's kind of like, 3 levels deep. In technical land, these are called the short step, the long step, and the signal step. The step is the value of the exponential moving average. So that's why in MACD you've got 3 numbers. What does this all mean? Very little, frankly. Well, what it means, though, is that some guy invented this a long time ago, and it's a really good measurement of direction. Here is a MACD example. They say when the lines cross is when you have a change in direction. The line crosses right here, and sure enough, change in direction. Lines cross here, sure enough, change in direction. That's called a MACD crossover. Right here, change in direction, etc., etc., etc. The only thing I don't like about the MACD is it tends to lag a little bit. For some reason, I didn't show one here in these examples, but the one I like to use more than MACD is called stochastic. It seems to be less of a lag, but that being said, they both operate off of very similar principles. MACD histogram is a close cousin to MACD because it's really the same thing, except it's drawn differently in the graphics. MACD histogram is one of my favorite indicators, and the reason is because it is so visually blatant. It's so easy to see what you want to see. The MACD histogram really generates a bunch of bars like you're seeing down here. This is the MACD histogram across here. The reason I like the MACD histogram is because in a split second you can see what's going on. You don't have to see these lines crossing. No more spider web phenomena. My own observation of the MACD histogram is what you want for a really good setup is you want a staircase type of growth in the red or green bars, depending on what direction you want. For example, if we go back here, see how this thing here is you can't see it very well, but there's a little tiny bit of red there for the histogram. All of a sudden it turns green. Where you really have a powerful setup is when it has a staircase type setup, where it gets increasingly green, and I love that pattern. You can almost take it to the bank, especially on certain stocks. So here you see that staircase upwards, those 3 green bars It goes boom, 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 and look how strongly that stock rallies for about a week. Right here, you've got, granted only two, but you've got a double staircase red, and look how badly that stock crashes. This here was kind of a false alarm. You have a nice staircase, and you would have gotten probably would have lost that trade, but you got a strong staircase there, and you got a very, very steep rally, etc., etc. MACD histogram is really excellent when you want to look for a change in direction. You day trader guys, you want to know how to catch a falling knife? The answer is the MACD histogram. In fact, let's look at one real quick, just for the hell of it. In optionality. I'm assuming that somebody wants this quote-unquote day trade. What does one look at? Netflix? Did it have a lot of action today? Kind of went sideways, but let's take a look at it because it had a lot of heavy action. Let's get rid of that indicator. Let's turn on a, okay, we got a 5-minute chart. I don't know if it'll show very well in a 5-minute. Let's try it. MACD histogram. That's a bad example. Well, maybe not. Maybe if we get it. Yeah, that's not too bad of an example. If you want to day trade this sucker, okay, you see how the stock is falling? It goes spiking up out of the gate, right? And it goes falling, 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 falling. Notice that while it falls, the histogram is red. So you guys who think you know what you're doing and aren't looking at the histogram, you think you just want to jump in because you're thinking something like, well, this sucker can't go any farther. Or this has to be at support. We've got to get in. No, because the histogram is red. As soon as that histogram stops going red, which is right here, that's your setup, right? That's like an alert. You're going, okay, but check it out. It finally goes green. There's a couple of green bars there. And check it out. It ramps. It doesn't look like much, but that's quite a climb in about a 15-minute period. And it stays green all the way till here, right? And it turns red. So that's time to either get out or go short. Sure enough, guess what? It goes, I hate that when that pen slips. It goes green right here, and it ramps. So it's very interesting. A lot of you guys don't like to day trade. I don't even day trade anymore, but the histogram is really good for that. To know, you know, I'm answering the question, how do you know when to catch a falling knife? That's the answer. Because the knife histogram changes color. It's very interesting. Anyhow, enough of that. Okay, another indicator we want to look at, which I use occasionally, is the Relative Strength Index, or RSI. This is actually a very widely misunderstood indicator because it's used mostly to gauge overbought and oversold conditions. However, that's not really what it measures. That's what people call it. They go, oh, look at the RSI is X, you know, is whatever number, right? It means it's oversold. Not necessarily. What it's really doing is it's sort of misnamed because at first it seems misnamed at first so you understand what it does. RSI uses recent gains and losses to measure the velocity of strength or weakness. In other words, how fast it has gained or lost. And the reason that works is, you remember our old friend anomaly of trend? Well, RSI actually measures the anomaly of trend. Because in this particular case, this anomaly of trend, this happened real fast when it goes flying down, see? Since that happens really fast, the RSI is going to really spike in the direction of being oversold. The reason why it's saying it's quote-unquote oversold is because it came down too fast, which means it's going to have like a dead cat bounce. That's really all it means. So RSI measures the velocity of gains and losses. And there are a lot of indicators very similar, like Williams. I prefer the Williams myself. I think it's more accurate. But it's on the same exact principle. And I'm showing you an RSI example. Now, by the way, I find that quote-unquote oversold, overbought indicators work best when you look for a change in its direction. Some of these oversold, overbought indicators, the problem people have with them is a stock can be oversold for a really long time, and it just keeps getting sold. The way the proper way to use these oversold indicators is to wait for it to shift. In other words, a V bottom with the oversold indicator. And this chart's a really good example of that. Right here, right about here, according to all the technology about RSI, right about here, this stock is oversold, according to the RSI. However, it keeps falling, all the way down to here. How do you know when that thing has stopped falling? Well, you can use the histogram like we showed a couple of minutes ago, but you can also look at the RSI itself. Notice that it's formed a V bottom right there. There is your setup. As soon as that oversold condition flips the other way, that's when you want to jump on board. And sure enough, it rallies. So RSI V bottom is very powerful. Okay, those are the indicators I mostly use. You're going to say, Gar, what about the PSAR? What about CCI? What about, yeah, there's hundreds of these, right? They all do the same thing. They're just different angles to look at things. Well, I can't say they all do the exact same thing, but you got to understand that the purpose of the indicators is a visual aid for you to see things that you might not have seen otherwise. Because, you know, some stock charts are really easy to look at and they're obvious. Others are not so obvious. They could be all over the place. And so the indicators can help you see things. Anyway, we're jumping into how Optionality-Pro scores stocks. I covered this in one of the original webinars. I'm going to give you a little more info this time. Okay, now you guys who have used PowerScan, as you must know, it's got filter after filter after filter. It's got built-in filters. It's got, you know, filters you might have made yourself. It's got shared filters other people have made. Some of them work, some of them don't work. The problem with all those filters is they find a whole bunch of different stocks, but you don't know which one is any good, right? So you keep the most common question I get is, Gar, which filter works best? Here's the problem. Here's what PowerScan looks like to a newcomer. And this is a problem. How do you make sense of all this? Which filters work best? Well, we've done all this work for you. You know, I can tell you right now, at least 10 of you guys that are watching right now are going to nod your head and go, yes, I agree. That's a little confusing. I'm going to show you that you don't have to go through all this. And you're going to go right back tomorrow on the Stock Vision forum and you're going to start looking at all the other filters again. You can do that if you want, but I'm telling you, we've done the work for you. And I'm going to try to explain how and why. But here's the deal. There's two main problems in answering this question. The question being, which filter works best? Or which filters work the best? There's two problems in answering this. And you have to solve both of these. And again, we've solved this, but I'm going to explain what these two problems are. The first problem is that not all stocks are created equal. This is huge. I made this discovery years ago, and ever since I've been scratching and clawing trying to solve this problem. And what do I mean by this? Here's the problem. Let's take a filter called V-bottom. There actually is a V-bottom filter. Now, a V-bottom detects when the stock chart forms a V. I've circled all the examples in this chart of a very strong V-bottom, all right? Now, let's take a much larger time period, and let's say that we go all the way back a year and we apply the V-bottom filter to this stock. And every time it trips, we'll draw a little box, and I've done that right there. Every one of those blue boxes means that the filter, the V-bottom filter, found that stock, so that we say that filter tripped. Now, of every one of those V-bottoms it found 14 of them. Only one of them lost. By lost, I mean it did not gain anything the next day or two. But all the other 13 of these 14 end up gaining, and some of them gained huge, as you can see in the chart. So, if this is the case, then the V-bottom filter has a 92% reliability, right? And then you're thinking, as a user who's just made this filter and you've back-tested it, you're going, woo-hoo, a great filter. I mean, look at the winners that it picked, right? You have to think again, right? Because let's take a completely different chart, different stock, and run the same filter. This is true, by the way. These are literally, this was literally tested before I did this webinar. These are two different stocks, the same exact time period, the same exact filter. This one, it found 15 hits. Almost the same, 15 out of, the other one had 14, right? But check it out. That's how many times it failed to gain. I don't know about you, but that's a pretty drastic difference. This one, therefore, only has a 60% reliability, according to its back data, of the V-bottom filter. Now, correct me if I'm wrong, but that is a gigantic discrepancy. But see, this is the problem with figuring out what filter works best. The answer is none of them, because they all work differently against different stocks. You see the problem. So, you have to solve that problem. Not all stocks are created equal. The second problem, this is one that's a little more subtle, and I've seen a lot of very smart people that use our stuff make this error. I saw somebody make this error last night, in fact. And that is, how is it performing against its peers? Now, I've made this mistake several times, and then until I figured out what was going on, and that's, okay, before I tell you explain this problem, here's the phenomenon. You create a filter, right? You use retrospect, let's say, and you backtest the hell out of it, and you come up with these magnificent results. You then go apply it in real life, and to your delight, it does really well for like a week and a half, and you think you died and went to heaven, and you think you're going to own all the money in the world from this. Suddenly, it stops working, and it starts picking loser after loser. What happened? Well, I'll tell you where your error was, or where your error probably was, and that's this. Here's your filter you created. And you got 3 stocks that it picked, and they soar into the clouds. And you're going, woo-hoo, right? Here's the problem. During that same time period, the whole stock market went up like that. You realize that if the whole market went up at the same time period, this filter is useless. Because you could have thrown a dart on the index and picked a winner. You don't need, that filter did nothing for you. This is the most common mistake people make when they're testing a filter. You have to compare it. You have to see how much it outperforms its peers. By its peers, it means simply the stocks that the filter did not find. Okay, if it found 3 stocks, how did all the other stocks do that the filter didn't find? If they all made similar gains, then the filter is useless. It didn't pick anything. Now, in this example I'm showing, if and only if, let's say instead of these yellow arrows, let's say the market went sideways during that time. Well, now you've got something. Now you truly have a powerful filter because your stocks went up and the whole market went sideways. Now you've got something, see. And this is very tricky business to find a filter that can be that good. But that's problem number 2. All right. We solved this problem quite a while ago when GT Pro came out, and extensive backtesting, I mean extensive backtesting, had to be applied to discover what indicators or combinations of indicators actually matter, which ones outperform their peers. In other words, which one was not that, which one actually outperformed those yellow arrows. And we discovered which ones do and which ones don't. Remember, I'm saying which indicators, which formulas outperform. Then we do various combinations of those formulas to come out with filters. And now I'm going to show you the filters that work. And I'm using filters here very loosely because these filters, you guys could roll some of your own filters that do similar, the same thing that I'm going to show you. But what I'm showing you are the patterns that we find are consistent and work well and outperform their peers. There's not very many of them, but here they are. The first one is very, very simple: big buy, big sell volume. You're going to say, Gar, that's too simple. No, it isn't. You'd be surprised how powerful this is. By big buy volume, that means price going up with above normal volume for the stock. And here's an example. This stock is obviously going up right here, right? But look at that volume. It looks like 6, 7, 8 times its normal. And by the way, back here it did the same thing. Big buy volume, and it was above its normal during that period. Notice that in this big buy volume, the stock just ramps up. This one here just soars. Well, that's kind of a momentum filter, but it's super simple, but it's very powerful. In fact, it's so powerful, I used to use it exclusively. Before we had GT Pro, I used to run Power Scan, I used to run Big Buy Volume, and that's the only ones I would even look at. And then I'd walk through the list and see if I liked them. That's all I did. Big Sell Volume is the opposite. You got big red volume. Look at that sucker crash. That's simple but powerful. That's number 1. These are not necessarily in the order of effectiveness. I'm just showing you the ones that actually work. The next one that works super well is the V bottom, V top. We just covered that a little while ago. So I don't need to go into that very much. But generally, V bottom is when it forms a V, and V top is when it forms an upside down V. Look at this. This stock is a super good example of how powerful that is. Look at your V's. There's your V bottom there, and look how that thing just flies. There's your V top, and look how that thing crashes. Very super powerful formula, or combination of formulas, I should say. By the way, I'm solving the mystery for any of you that want to know which filters work best. I'm telling you which ones work best. Okay, overbought, oversold, reversal. By the way, notice I'm not saying overbought, oversold. I'm saying overbought, oversold, reversal. That's the key word. I covered this a little while ago tonight, remember? It's we call it the oversold V bottom, or overbought V top. This here is the Williams indicator. Notice that when it forms a V, when you literally have a Williams V bottom, which is the one right here, that is a classic, beautiful setup. And sure enough, this stock gained for 4 straight days super strongly. A good example of why you want a V is look at down here. Right here, technically, Williams is showing oversold conditions. But if you're just going by pure oversold, like right here, for example, Williams is super low. That's about as low as you can get on a Williams, right? That means super duper oversold. Okay, so you're a hotshot trader. You like to trade oversold. So you enter right here. You got nothing. It goes sideways. It goes sideways, then it eventually falls, and you get stopped out. You say, what did I do wrong? The answer is you didn't wait for a V. Your V is right here. And look what it does. You see that? So here's another beautiful V right here. And the stock rallies for over a week. You don't even need the day trade. You can sit there and go to sleep and let it run, you know. It's hard to see here, but there's actually a little V top right here, right? It crashes. But I digress. Anyhow, very powerful pattern. And then there's channeling. I'm going to cover channeling a lot more in next week because I've actually been working on this for a long time. A lot of people don't like or don't understand how to trade some of these indicators or setups. They'd rather just do a more mechanical, systematic red light, green light thing. I'm actually developing something just for people like that. And it has a lot to do with channeling. But channeling turns out to be, believe it or not, to be one of these filter thingies that work all the time. And I picked a stock here that has a really good channeling example. Channeling means that a stock's trading in a channel. Here's your channel. Here's your top of your channel. Here's the bottom of your channel. It's pretty straightforward, right? Whoops, I skipped ahead. It's top of the channel, bottom of the channel. Every time that stock hits your channel on the bottom, you ride it back. Hits there, you ride it up. Hits there, you ride it up, okay, you break even on that one. But it does hit there again, and you really win big on that. You see that. If you're a short seller, as soon as it sits there and it hits its top, you can go short. That'd been a nice short right there, right? Now, there's a couple of times you'd either get stopped out or gain nothing. But for the most part, you'd have way more winners than losers. There's an actual website that used to be popular called channelingstocks.com. All they did on that site is give out these kind of stocks. So everyone in there, could just sit there and red light, green light themselves to death and play these things. I don't know how successful they were, but this was the principle they were basing it on. But don't forget the first problem of filter testing. Not all stocks are created equal. That includes channeling. Not every stock is a good channeling stock. And there is your pitfall, even if you have a good filter. What works on stock A might not work on stock B, but I'm going to get into more of that later. The next pattern that is very powerful, that really works, is breaking support and resistance. This thing I'm showing you, by the way, is from agonizing back testing and trial and error and experiments and et cetera, et cetera. Breaking out of support and resistance means exactly what it says. Right here is resistance. How do I know that? Well, first of all, if you go back here, it was resistance there. If it was resistance there, there's no reason why it shouldn't be here as well until it proves otherwise. So the stock's meandering around. It finally gets back to its resistance line, which is right here. And sure enough, it goes bounce, 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 and it falls. It goes bounce, 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 falls. It cannot break through that resistance line until one day, boom, it busts right through it. That's called breaking resistance. Even better yet, we got an increase in volume, which then that becomes a breakout. Notice how, talk about a winner. That's a momentum play, see, because it broke resistance. Now, breaking support is the exact opposite. Right here you've got, I'm sorry, yeah, breaking support is the exact opposite. Right here you've got support. The line I just drew is that's your top resistance now, but that's your support line. No, how do I know that? Because it goes bounce, 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 bounce. All of a sudden, boom, crashes through. That's breaking support. And it's hard to see that, but you have a nice short sell for 4 days in a row. Now it starts to meander back up, because remember, right now the market's like a balloon underwater, but that's a different story. The point is, you would have had a beautiful trade setup right there for short because it broke support. Very powerful setup. What I just showed you is it. I am not aware of any other patterns that work as well as those I just showed you. Therefore, when GT Pro was, or at least the newer version of it was developed, we used just those patterns and made filters based on those patterns. And there's about 20 bull filters and about 20 bear filters that revolve around those patterns, and that's a huge component of what gives you these scores. Now, the way it scores takes into account the first problem, which all stocks are not created equal. Here's what happens. Every single evening, in fact, right now it's happening as we speak, every evening, our servers crank using these 40 filters, and this, by the way, takes hours. There's so much data. It cranks, and it goes through at least 6 months of back data. I think it's actually a year of back data with 2,000 stocks, and it applies every one of those filters, all 40, to every 30-minute interval against that 1 year of back data on 2,000 stocks. Now you can see why it takes hours. But by doing so, it produces the track record of each stock for each filter. Remember I showed you like 20 minutes ago the example of the V bottom? The first stock had a 92% track record. The second stock had a 60% track record. That's the sort of thing this figures out for every one of these 40 filters. And hence it comes out with a score that's connected to each filter. Hence, if that filter trips, you know what the stock's chances are according to its back performance. So, in real time, when you guys get up and you come to this product and the market opens, these filters are applied to all the stocks in real time. So let's say this one filter finds stock, stock, stock. It already knows its chances by the last night's back data, and so it comes up with a score. So if you see a 67, that means that whatever filter it found, it's performed 67% of the time favorably. And stock number 2 performed 96% of the time favorably, and stock number 3 performed 82% of the time favorably. So what I'm telling you is these scores are a lot more powerful than you might realize. These scores are solving the two problems, which is number 1, all stocks not created equal, but number 2 is which filter is best. The complicated answer to that is handed to you on a silver platter in these scores. Now, does that mean you trade them blindly? No. I warn against that because these are just filters, right? These are not crystal balls, or they're not all-seeing or sages. They are just giving you a hint that this stock ought to be looked at. And then that's where you use your training and knowledge and, yes, even your intuition to make a decision. However, if you had to trade these blind, I showed everybody in a couple webinars ago, I showed everybody the blind portfolio results. I had to see how accurate these scores are, and I've been having the server test every stock with a score of 90 or higher, long and short, as if it was blindly trading them to see what kind of results we could get. And I've been frankly astounded of how well it's been doing. I still don't recommend you trade this way, but I want to convince you guys these scores really are pretty accurate. Because here, I'll show you the results. I showed this to everybody a week or so ago, but I've added on to them because there's been more data since. This is a spreadsheet that has every quote-unquote trade. None of these were actually really traded. They were simulated. So when the thing's cranking away during the day, right, it comes up with a 90 score or higher. The same thing you would see on your optionality screen. These are all stocks, not necessarily just options. Now, if it sees a 90 or better, it pretends that it buys the stock. The rule that I programmed it for is that if it gains, these are all for 3-day time frames, by the way. If it gains 1.5% or better, close it out as a win. If it loses 3%, close it out as a loser. Or if the 3 days pass, close it out, win, lose, or draw. And so in other words, if there was a 3% stop and a 1.5% limit gain to sell. And on this spreadsheet, I pretended that each trade was traded for $1,000, however many shares that bought. And this is the running total if you put $1,000 on every one of these guys. It's just about, I think this is since November. And these are all stocks above 90 or above in the score. And playing $1,000 on each stock, you would now have, come on, come to the end here. You wouldn't really do this. This is absurd. But the point is that how well this works. You'd have 1,582. Now, that's a little unrealistic. You're not going to trade every stock because a lot of times there's, on some days there's like, 15 positions. But I didn't know any other way to tabulate it. Because remember, there's no human being here making a decision. And you're saying, yeah, but the market's been doing well, so of course these are longs, of course they're going to do well. Yeah, but look at this. Here's your shorts. Now, I haven't been measuring shorts for as long, but shorts, in fact, only about half the time I've been doing shorts. It is only up $1,000 a trade. It's up $400. That's not as good. You see there's a lot of reds, which tells me that the market is hard to short, for heaven's sake. Although there's beautiful winners right in a row there. That must have been when we had a down market. Anyhow, I don't want to go on and on about this. The point is these scores are pretty good. Now, what I'm going to do is, by the way, when time permits, I'm going to go through every one of these losers. Here is a big losing streak right here. I'm going to go through every one of these losers and see if they have anything in common. And from that data, we can tweak it. We can make these formulas and scoring even better. Anyhow, I thought that'd be interesting. Everybody, the good news is I can improve on the scoring by going over this track data. That's the real reason I'm doing it. I'm not doing it to prove to everybody that it works, because I know this stuff works. I've been doing it so we can improve on it. Can you imagine if it said 90, it was truly a 90? Right now, according to this statistic, that 90 is really more like a 70. In other words, what do I mean? In other words, if it says 90, I'm finding that it wins about 70% of the time. So I need to tweak these a little bit so they're a little bit more accurate. But 70% is still pretty damn good. That's all I got for tonight. And then now on that note, hopefully happy note, see if we have questions. Somebody asked me right away, why are there gainers over 1.5%? Well, because it's holding them for 3 days or 1.5%, right? A lot of those gainers spiked up the next day. That's one reason. Another reason is sometimes they spike really fast, and so as soon as it, when this is testing these trades, it only samples it maybe once every 30 seconds. And so what if the thing could have gained 2% in like literally 15 seconds? That could happen. But most of those big gainers were because they got closed out the next morning, on a gap up. There were also some that were well below -3%. That was for the same reason, because they gap down, right? And they get taken out like at -5% or whatever. Joe says, do you need to get PowerScan to do these scans? No. Oh, okay, maybe I didn't. I probably should conclude this, shouldn't I? Optionality-Pro. It does these scans automatically. See, these filters I was telling you about that we back tested and they work better than anything else. These are them right there. Those are all the filters. The default is all filters, all right? What that means is that the system is running those filters constantly against all stocks. And so it's doing this for you. Now, if you say, can I create a filter and add it to the list, the answer is no. Not in this version. Maybe we'll come out with one later, but these are all built in with Optionality-Pro. So the point of this, remember what I said about 40 minutes ago, as confusing as all those filters are, you don't have to figure any of that out. We've done all that work. So now your job is to understand charts and to go to the list and go, is that one any good? Is that one any good? Is that one any good? You see? So we've done all the hard stuff. Right now, the easy part is to go through these high scores to figure out if any of them are any good. And that's where all this training is. That's where practice comes in. That's why you have a paper trader. You start learning what works and what doesn't. Okay, let's see what other questions we have here. Yes, somebody says, are these daily charts? Every chart I was showing you tonight was daily. The one exception is I think I was showing some kind of day trading technique. I was looking at a 5-minute chart. That was live. The pictures of charts were all daily. Someone here is asking, where can I find replay of these presentations? Go to the way you're going to find them generally is go to our website. On the home page, garsworld.com, on our home page, you'll see the product being advertised, and then you'll see more info. Click more info. On the right side of that page, there'll be a place you can log in with your username and password. That's called our Options Academy. If you go in there, there's links in there for registering for future webinars and for recordings. There's only one recording up there right now, which was Tuesday's. It's up there right now. But we'll also send out an email, probably tonight, or if not, tomorrow, that'll give the link to the recording. And yes, I know we sent an email that had images missing, and so everyone thought there were no links to the webinars. There were links, just the images weren't there. Stupid. Okay, someone asked a question here. Does the one-day hold column relate to open of market to open of market, close of market to open of market, etc.? Same thing for 4-hour hold. Okay, these hold times. Let me explain these hold times. What he's talking about here is in optionality, or these guys, these brackets here. Hold times means, okay, this you got to understand this, because people are always asking me about these hold times. These hold times just simply tell you how the score was obtained. That's all it's telling you. It is not, I repeat, it is not a suggestion or even a guide as to how long you're supposed to hold or when you're supposed to enter. That is irrelevant. What the time periods are telling you is how the score was computed for that point. So, for example, if you have 1 day selected, which I do right now, see, I'm on 1 day. It's saying that MTG's score is 80. What that means is when this filter hits within 1 day, in other words, within one trading session period of time, that stock gained at least 1.5% when that filter hit in the past. By 1 day, it means 5.5 hours, because a session on Wall Street is 5.5 hours. So, if the filter tripped 10 minutes before the close, then for that test, 1 day would be 10 minutes before the close the next session. If it hit at 1 minute after the open, then the test would be 1 minute after the close. You see, it's measuring. A day is 5.5 hours. Now, if you have 4 hours selected, it's the same thing, but it's in hours. So the score here is 70. That's saying that within 4 hours, sometime within the 4 hours after that filter hit, stock gained 70% of the time. It could be any 4 hours. It could be the last 2 of the market today and the next 2 in the morning. It could be 4 hours during the day. It could be 4 hours from the morning till afternoon, whatever. That's all the time frames mean. It means how the scoring was computed. I hope that is clear. I hope that's as clear as can be. Someone points out the one thing I might have to tweak on the spreadsheet is 3% is different for a penny stock versus a stock that's $50. So you might need to somehow classify the difference in those price ranges. Yeah, I know what you're saying. I could take that into consideration when I study it as far as how to improve the formulas. But for now, the only point of the backtesting is to see how generally accurate the scoring has been. So I do understand that a 3% stop for a $1 stock is a really, really tight stop. That's kind of what you're saying. And maybe it should be a little wider. But, there's all kinds of ways we can improve on the backtest or the tracking that I'm doing. Paul points out, it looks like the V tops and V bottom channel resistance and support may amplify both indicators. Yeah, V bottoms and V tops tend to occur on support and resistance. They tend to. Joe asked, do I only look at the high scores? Yes, I only look at the high scores. I don't even consider the low. Of course, now the next question will be, what is a high score? Well, you tell me. I mean, it depends on how much risk you're comfortable with. I personally don't like to consider anything below 70, let's say. Now, I'm talking 3-day. Remember, these scores get smaller and smaller the smaller the time frame you get. See, right there, that same stock is only 42, whereas for 3-day, it's 99. They get smaller as you get a smaller time frame. But I usually only look at 3-day, and I'll go down to those 70s, and I'll never go below that. But let me tell you something else, you guys. One of the most frustrating things, to, especially that people don't understand it or are new, is these scores can really fly around a lot. And you can be watching them, right, and you'll see a 99, and you'll look away, and then you'll turn back to the screen, and then it'll be gone. That's because the filter is coming in and out. Because remember, the scoring is based on a filter finding the stock. If the stock gets tripped by the filter, then on this next pass, the stock changes and it's no longer in that filter. Well, the score is not going to be there anymore. The fix for that is to, one way you can get around that is to look at your high score. See that? That's the high score of the day for the stock. Sometimes I do this, and especially midday, I'll go and look through the high scores. See right here, this guy here, even though it says NA for score, which means 0, means it doesn't know, it had a high score of 88 at some point today, so that's worth looking at. Maybe it's just pulled way back or something. So high score means it hit that score at one time or another in 2 days session. Any other questions, comments? Joe wants me to go over the end of day period, EOD. All right, I'll do that real quickly. EOD means end of day. This is a new feature we added in the last revision. End of day means, remember, these are all back tested to get its score, right? There's a special back test applied only for end of day, meaning the last half an hour of the trading session. It measures everybody's performance against all the filters for the last half hour into the next session. So, for example, let's say it's a V-bottom filter. Let's say that we test with a V-bottom filter in the last 15 minutes of today's trading session. There's a special score for that, which is why we have a special time slot called end of day right here. That score tells you how well that stock has performed when that filter hits in the last half hour, how well it performs in the following session. In other words, the lunar type of play. So if it has a pretty high score, that means it has a really good chance of advancing in tomorrow's session early. The only time you'll see that score and the only time it's valid is in the last 30 minutes. Right now, they are all zeros because the market's closed. It only does it in the last 30 minutes. Does it work as a productive? Well, for any of you guys hanging around Gar's Gold, me and a couple other guys went in on an option yesterday at the end of the day called Walter's Energy, WLT. It had a really nice fat score for end of day, so we jumped on it. Now, unfortunately, it didn't go up high enough, but it actually did produce, which was quite amazing. It even gapped down this morning, much to my shock, but then it ramped right back up and went up. God, I think it was up like over 2% at one point early in the day. It's amazing as it just didn't get high enough, or I think what it was is the option was too illiquid. We couldn't get rid of it at a good gain. But the maddening thing is, and I guess the pleasant thing is, the fact that it actually worked. It actually called Walt, WLT, it actually called it. It said, this sucker has a really good chance of ramping up tomorrow morning, which is exactly what it did. That is actually amazing to me, even though it's not a winner yet. I think a couple of us are still holding it, but it actually works, you know. Somebody's going on and on about something's on their screen and not on mine. And I don't know. Let's see here. What are you talking about? 3-day. Okay. Yeah, the thing is, if you see a different stock, uh, I think you're talking about PII. What price is that stock? Because I have my preferences set to stocks above a certain price. That's probably what's going on. Or maybe it's a stock. Yeah, see, I don't even have PII. It's probably because it's a cheapy stock, is it? That's what I'm thinking. Yeah, see, I have my minimum prices at $4. I don't even have PI. I don't even have that stock in this list. I'm not sure what is it PLL? PI? I don't even know if it's any such stock. I don't see it in here. Now, let me go on to the next question. I don't understand that one. Let's see. The screen will be sorted by the highest score at the top. Then the screen flashes and jumps down a ways, and you have to slide the bar up to the top again. Okay. That's a very common issue. I'll tell you why that's happening. It's because you have a stock selected. So let's say, for example, you select this one, NUS. Let's say it flies down to the bottom. Let's say it goes all the way down to here. The problem now is because you have that stock selected down here, when it refreshes the scores up here, it's going to want to scroll to your selection. So it's going to scroll down. The way you make that stop happening is you scroll to the top and then click on the top guy, and it'll keep it from scrolling. I don't know any fix to that because the user is going to generally want to scroll to the stock he has selected. You know, that's the issue. I guess we could have a checkbox that says don't scroll to selected. I don't know. Any suggestions on trading 52-week highs? No, not really. I mean, I don't know of any reliable methods of using that data. As a matter of fact, I find that when it's hit 52-week highs, it's probably overdue for a correction. The exception to that is if it's got a lot of momentum and the market's not peaking out. Then you might, but to me, a 52-week high doesn't really mean anything. It just means that the stock's, well, the only meaning it has is the stock doesn't have any resistance per se, because if it's at a 52-week high, it's probably not near any resistance. That's your one advantage with it. However, that's only valuable data in a bull market. If you're getting bearish, if the market's turning bearish, they're gonna crucify that thing. You know, in a bear market, stocks flying high like that have a different kind of fate. They become sitting ducks. You know, they get picked off one by one. But in a bull market, they tend to keep ramping higher and higher and higher. You know, like Netflix. Yeah, it's like knowing what that symbol is. That looks like PIIPLL. There's no stock in the list that like that. Oh, wait a minute. So maybe it is volume. You're mentioning now that you changed the volume and it doesn't show up. Let me see. What do I have set for volume? Yeah, I have 700K. Let me set it to 0. See what happens. Ah, there it is. I wonder why it thinks its volume is so low. Maybe it. Oh, okay, I know why. Because it is. Yeah, that's tricky because it measures like for the last 30 days, and the last 30 days, this volume is. Look at this volume is terrible back here. So that average volume is going to come up in the near future because see, this volume here is pretty good. But even that's not very much because those bars you see there, these bars for this stock is only 50K each. So the stock's only trading a few 100,000 shares a day usually, particularly back here. That's why. All right, mystery solved. But that answers your original question. Why is PII showing on yours and not mine? It's because I had my volume set to 700,000 shares average per day. Alan's saying he doesn't see stocks like SCTY, DUST. Look, some of those stocks are outright not on the list. You see, you got to understand something about this master list. We only update this master list every once in a while. But when we make the master list, at that moment is based on stock price and volume at that moment. If it doesn't match the criteria, it's not going to be in the list. And it might not be in for a really long time. Look, we're way overdue to create a new master list. We have to do this is because we cannot monitor all stocks. There's too many of them. We don't have the data feed to support that many stocks because there's actually, if we did the entire stock market literally, we'd have to monitor about 12,000 stocks. And our data feed can only support 2,500 simultaneous symbols, which is a lot. You're thinking, yeah, my broker can do all stocks. No, he can't, not simultaneously. Let's see you set up a watch list with 2,000 symbols in your broker and see how well it works in real time. Also, they're paying really, really, really big money for that data feed. But they're getting it back by charging all you guys commissions for every trade. Any other questions? The next webinar is going to be on next Tuesday, and yes, you'll get emails. If you don't, just send me an email and say you didn't get it. You know, sometimes these go to spam filters or spam boxes. God, I hate spam for that reason. You can't get legitimate mail through a lot of times because of other spammers. Very annoying. You know, spammers don't think, they think, oh, we don't hurt anybody by doing this. Yes, you do. You hurt me. I can't get emails across sometimes because of it. Important emails, you know, like webinars, links to things. That's a whole different story. Here's a question. Why is it better to have a broker? Wouldn't it be better to enter the trades myself? I don't know. I don't know how to do that. The broker's the middleman. I don't know any other way to do trades, especially from my computer in my room, except to have an online broker. I don't know any other way. I guess there's guys that could do this on the floor of the stock exchange, but how you get in that position, who knows? Got to realize the whole trading game is I don't want to use the word rigged, but let's say it's set up a certain way where everybody gets a cut, you know, and they make it very difficult to get either information or direct trading without going through some middleman guy. direct trading software like Options Express and TradeStation, no, you're still, those people are brokers. They say direct, that just means they're not going through a middleman. No, TradeStation is a brokerage. So is Options Express. There is no such thing as going directly to the exchange by your lonesome. And those guys are charging you commissions. TradeStation charges commissions. Option Express charges commissions. When they say direct trades, that means that they route your orders right through these electronic networks. They don't go through yet another middleman. See, because there's that's a whole subject by itself. Maybe we can cover it in a different webinar, but there's all kinds of various paths to the final destination, the stock exchange itself. And there's things called ECNs, which are electronic networks that are a direct link, but somebody has to provide that path for you, and it's the middleman called the broker, and he charges you a fee for that. I suppose there might be some way to get your own ECN, but I don't even know how to do that. It'd probably be really expensive. Let's see here. Joe says, I noticed that the pit of hell stocks don't seem to cross the Bollinger Band. That's not what the pits of hell's filter does. The pits of hell is looking for the Keltner and Bollinger are overlapping, and that shifts. And then as soon as that shifts, remember the Keltner bands and Bollinger bands, they overlap. And when they shift from one side to the other, that's the setup. And then the up or down indication is where the stock is trending at that moment. It has nothing to do with breaking the Bollinger Band or anything like that. Okay, any other questions or comments? If not, I'm going to shut down. I hope you guys got something good out of this. It's always fun. And next week, the next session is going to be about winning. In other words, we're talking all theory, right? Next time, I'm going to show you actual ways to find and execute a good setup to actually get some winners. One thing I'm going to emphasize too is there's no such thing as everyone being a winner. You're going to have losers. The one certainty in the stock market is you will have a loser, and it's how you deal with that is the real criteria. All right, I'm going to shut down. Thanks for attending, and I hope to see even more people next time.